And every new revelation that I'm sharing is opening up a huge level of understanding about how everything else is working. Contrast that with you go into the day and you're waiting to react to something. As a retail trader, you're waiting for some kind of price movement away from a VWAP, or you're waiting for some kind of, I don't know, indicator to tell you it's doing something, or some kind of pattern that is populated on your chart as an overlay that tells you there's supposedly some harmonic pattern there. And you're trusting that stuff. But you're admitting to yourself that, hey, look, nothing's 100%. If I'm wrong, it's okay. It doesn't mean that I'm going to keep losing. It just means that I'm okay losing half the time. And to me, that makes no damn sense. But gamblers do well with that. Professional gamblers can do well in those types of situations because they know how to bet heavy when they feel like they got it in their favor. And they'll lose a lot of hands, and they'll find themselves at the final table at the World Series of Poker. Watch those competitions, and you'll see the same faces finding themselves to the latter stages of that competition more times than anybody else. And that was always a fascinating thing for me in the 90s. Like, I watched that all the time, and the same people would be at the tables, the last ones. That's not coincidence. They know how to play the cards, and they know how to play the people at the table. And that's exactly what market making is. That's what it is. It's bluffing. It's enticing. Throwing down a hand that you know you probably could play, but throw it down. And what they thought you were playing with, and you're confusing them. That's why if you go to a casino and you sit down at a blackjack table, they bring out a brand new shoe, okay? And you start playing the table. When you got a good hand, throw it down. Lose money doing that. Throw it down, throw it down, throw it down. What you're actually doing is you're going to mess up the shoe. And in 15 minutes or 20 minutes, they're going to come out and change the shoe or ask you to go to another table. That table's closed. Don't believe me? Go fucking try it, okay? Because the eye in the sky above you, that's who you're trading. That's who you're playing cards against. It's not the dealer. That shoe is a stack, okay? It's a stack, meaning that there's a specific order of the number of cards in a row. It's going to be this rotation, okay? They're not randomly shuffled. They're not stacked in there where anybody has a free chance to get the random take of a card. That's not how it works, okay? It's not how it works. When someone's winning consistently, they will come out and they'll change the shoe. The shoe is that little box, in case you didn't understand what I meant by that. On the table, there's this big box of multiple decks of cards, and they're all stacked in there in a specific order. It's stacked in a way where anybody that understands the game of poker, it will lead them to take a specific card and say, okay, I'm going to try to play this, and I'll discard that. It's not perfect. It's not perfect, but it at least primes them to play the cards that they're given. But if you start making consistent wins at that table, they're going to come out and change the shoe. Not because they ran out of cards. They want to disrupt you because you have now counted the deck. You have that shoe understood. You know exactly what's coming out. That's why card counters are not allowed to play in casinos. Let me tell you something. I don't care. This is my perspective, Lynn. You can have a different opinion. But if someone comes in, even with partners, and they're counting cards together, and they have electronic devices telling the other person at the table, hey, look, this is good, this is not good. How the fuck's that cheating? That's not cheating. They don't know what those cards are. They don't know what they are. They're just counting. They have a card counting system. They don't know what card they're going to get. They're just playing the odds of what's still available in that deck. How many face cards are still there? How many aces are still there? And when the deck or the shoe goes cold, they got to get away from that table. But they'll cut your arms off in casinos. You start taking big money from them like that, you won't leave with that money. You won't be allowed to cash those chips in. And they're going to try to prosecute you. Imagine that. And here they are cheating the entire time. cheating the absolute entire time, guaranteeing that you have all the odds against you. But when you start winning, oh no, you're a cheat. We can't have you here. You got to go. The market doesn't like hard counters either. And when you know, they make it a little bit harder for you. I'll just say it that way. Okay. So what you want to do is learn what it does, how it books price, and then casually grow over a period of time. Don't flash in the pan, go out there and try to run it up real quick, because all you're going to do is put a spotlight on you. And that will start being a problem for your trades. They'll slip you, they'll requote you. Other things that I'm not going to talk about here, but same treatment as a card counter, let's put it that way, but just in a different approach. So if we can agree, just for the sake of this discussion, just if you don't believe there's an algorithm, this, for the purpose of me explaining something to you, just pretend for a moment that you do believe it is, okay? And then at the end of the conversation, then you can move back to whatever you want to believe afterwards. But if there is an algorithm and it controls price and it only affords the market to go so high or so low for that given day, that means from the time it starts trading to the time it settles for that session, all of that price fluctuation, everybody in the retail perspective are all going to see it as random price delivery. And there might be a pattern there that may justify them taking action on it. So they have a religious belief in some kind of pattern. For the sake of the pattern, they're going to buy or sell. And I'm trying to offer you a different perspective where you should be thinking, okay, what is the prevailing market sentiment right now about that given market? Is it likely to continue higher or lower for the next several days, up to the whole duration of the new week coming? Okay, because right now while we're talking, it is 40 minutes after 10 a.m. Eastern time. So we have several hours before we get to the new week opening at 6 o'clock Eastern time. So the markets are flat, they're not trading right now. And you should be thinking about what that monthly, that weekly chart is doing. Would seeing the price dropping lower to an old low or a gap of some sort, would it be beneficial for smart money if they were short? Would it be beneficial based on what that monthly and weekly chart shows right now? Would it be beneficial if the market was likely to go higher if smart money was long, to go to an old high or go to an inefficiency above where we settled at on Friday? That's your first question every single Saturday or Sunday, or if you do your analysis in the Friday evening or whatever. But before Sunday's opening, you need to do some reflecting on the monthly and the weekly chart, because it should give you a long-term slow expectation where price is likely to go. And if it's not obvious, then drop down to the next lower time frame, which is going to be the daily. If you can't ascertain where the market's likely to draw to on the daily chart, then you absolutely have no business dropping down into the lower time frames, because you will be gambling. You will absolutely be gambling, because you won't know, trading on these smaller time frames, when that next trade you're taking is actually a higher time frame entry that's going to be the biggest displacement. And if you're trading without a stop loss, which I see a lot of that, just look at the screenshots everybody's tossing around between each other on Twitter, on Facebook, and on Instagram. They don't even put a stop loss on, even to save face, because they know if they put a stop loss on there, even though they don't have one while their trade is panning out in their demo account, they don't want to put that stop loss on, because everybody will know with a record that that's where their stop loss was. And when the market eventually goes down to that level, they would be technically stopped out, because they don't want to get stopped out. They want to hold on to something. If it keeps moving, they can come back and say, see how smart I was. So that's why when I look at people and they share charts and they say, I got the same trade as you, ICT. First question is I want to see the execution. I want to see the price. not the line, because the line could be 3 days ago. And it just so happens to look like it moved away from that price level. So I call my own students out with that bullshit. When I see people share a trade and they're a student of mine and they show their entry and they show they're getting ready to get their limit order tagged, but there's no stop loss, I'm not congratulating them on their good entry. I'm not congratulating them on the right draw and liquidity as an exit. I'm criticizing them by saying, where's your stop? Use a stop. That's mentoring. That's a mentor. That's someone that's trying to teach responsibility. I'm going to find your weakness because you're ignoring it and you need to work there. And in the marketplace, it capitalizes on everyone's weakness. What are the two most critical ones? Greed and fear. All it has to do is operate on those two pretenses. It's going to either scare the shit out of you or it's going to entice you that you're going to make a lot of money. Either one of them is going to cause action. It's going to cause a reaction, a response, a cause and effect. As a human being, you don't always know how you're going to react to something. And especially in trading, because most people don't do a lot of documentation stage of the development in the beginning. That means journaling, tape reading, identifying in laboratory experiments of watching price action, recording what your emotions are. Even though there's no money on the line, even though you haven't even pressed a demo entry, you are emotionally committed to the outcome of whatever opinion you form based on that chart at that time. Don't believe me? Think about this. You've opened up Eurodollar. You opened up Japanese yen. You've looked at coffee futures if you're a commodity trader. You're looking at Bitcoin if you're a crypto crazy guy. And now for futures, you're watching NQ, Dow, NASDAQ. And you look at the chart right away, you're like, oh, I think it's going to go here. And it doesn't go. Oh, it doesn't matter because I wasn't in the trade. You quickly dismiss it. You quickly push it away like, oh, it doesn't matter. No one saw me say that. No one heard me think that. I didn't press a demo entry. I don't have to reset a demo account. I didn't take a loss in my funded account challenge. I didn't take a loss in my funded account. I didn't lose money in my real account. You're making excuses to push it aside. That's the worst thing you can do. You need to explore why you felt that impulse to think, oh, it's going to go up or it's going to go down to this. When you dismiss those instances where you have impulsively committed to some outcome and it doesn't work, the first thing you want to do is push it away like it didn't happen. Wrong. Because when you start trading with real money or in a manner where it's going to take from you money or prevent you from reaching your funded account, because you're paying for those accounts. And if you get wrapped up in this loop of ignoring your faults, you keep doing the same thing over and over again, failing and blowing the account and blowing the account and blowing the account and never fixing the underlying issue. And the only thing that increases in fervent pace is your pursuit to quickly reset the account or pay for a new challenge. And that just proves that you're out of control. You're not in control. You're emotionally stimulated beyond all comprehension. You're hopped up on goofballs. You don't even recognize the fact that you're doing everything wrong because now you're now more passionate about doing it faster and quicker, and that way it'll cancel out that discomfort that you keep blowing the accounts. And you look at these people that are honest online and they're saying they've reset their account 100 plus times. I don't know how much that stuff costs. I've never done it, but that sounds like it's pretty expensive over time. And are you willing to reset 100 times and never make money? Because that's the equivalent of someone that goes to a casino and sits there knowing damn well that they have taken every bit out of their bank account. They only went there with a certain dollar amount. This is all I'm going to spend. But because they can't get out of that loop, that gambler's loop, where they don't recognize the tells that they have in themselves, the self-destructive impulses that you know, if you've been paying attention, you're about to start doing that. If you don't recognize those things, the market is going to capitalize on that. And it makes it feel like they come after you specifically. because you've ignored all the warning signs that you as a human being keep materializing and manifesting in your behavior, in your thought process, and in your executions, or lack of executions, or lack of using a stop loss. That's why in the beginning I tell people it's going to be 6 months before you should ever be pressing the button with money behind it, because not all of you have the same measure of character flaws. Some people have a lot of them, and it may require longer than 6 months. It depends on how troubled you are. But if you're a very detail-oriented person, you're honest about everything, and you're honest about yourself, and you're not trying to be something that you're not pretending to be someone that's more equipped than you really are, you're probably not going to require 6 months of figuring out what your problems are. But you have to identify what they are, because otherwise you won't realize that that is your downfall. And what I'm going to teach today is going to be the reasons why that takes place. You haven't identified how you're falling victim to yourself. Okay? The market's not beating you. You beat yourself. The market didn't blow your account. You blew it. 90% of the time, you knew before you took that last trade that blew your account, you shouldn't have done it. And you shouldn't be doing it. But you didn't stop. Because you're caught up in that gambler's loop. You're numb to it. Oh, well, if I blow it, I'll just reset it. And then I'll feel fresh with a brand new start. But it doesn't feel that way, does it? Because now you're scared. The next trade you take on your new one, I don't want to have a losing trade because that means it's going to freak me out. I'm going to jinx it. And then I'm going to go right back in the same thing. But you lie to yourself in that last trade before your account gets blown. If I blow it, I'll just reset it and I'll be fine. But you're not fine. You're building thicker and thicker scar tissue. And it's hard to trade in that. And if you're trying to be an online personification of a successful trader, but you're not proving that because you keep having to reset your accounts, that is even worse of scar tissue. So it's unfortunate because I teach these things and I prove it, and my students that do well and listen to it, they stand out. But I do have students that can trade, but they don't know how to wrestle themselves. They haven't done the documentation stage of their own development. In the beginning, they didn't do the things I'm teaching in this mentorship 2024. They have not spent any time doing that. So that's why they have hit and miss results. That's why they can make money. They can get a payout or two and then blow it. And they go into a tailspin for months. And then they might make a little bit of money again down the road, but then they blow it again. What's broken? Them. They are the underlying issue. You are always going to be the underlying issue. It's not the method. It's not the market doing it to you. It's you. So with that foundation, I want you to think about how 99% of retail traders have no concern for trying to make themselves prepared for the ebb and flow of profitability, losing in the beginning. They just want it to be a lottery win, and it's off to the races for the rest of their life. They just keep making more money. The way the market capitalizes on that weak mindset is because they're ill-equipped. The first thing that the market does every single day is it hides the narrative. What is a narrative? What the market's actually going to do for the day that makes the daily candle. That's the real candlestick range theory. Not that bullshit you see fucking panded around on Twitter right now. Nonsense.